What if building wealth didn't require thousands of dollars, but simply consistency, patience, and a plan? Welcome to the $100 Investor, your practical guide to creating long-term financial growth with just $100 a month. In a world where investing can feel complex, overwhelming, and sometimes out of reach, this audiobook simplifies everything. No jargon, no unnecessary risk, just clear, proven principles that work over time. If you're just starting your financial journey, rebuilding your savings, or looking for a disciplined approach to investing, this guide is designed with you in mind. You'll learn how small, consistent contributions can grow into meaningful wealth, how to make smart investment decisions with confidence, and how to stay committed even when the market feels uncertain. Because the truth is, wealth isn't built overnight. It's built monthly. One decision, one contribution, one step at a time. $100 monthly equals accessible entry point. When most people think about investing, they imagine needing thousands of dollars to get started. Large sums, complex strategies, perfect timing. But the reality is far simpler and far more powerful. You don't need thousands to begin. You need consistency. $100 a month may not sound like much. In fact, it can feel insignificant in the moment. But over time, that small, consistent investment becomes something far greater. Because investing isn't about how much you start with. It's about how often you show up. $100 a month is accessible. It's manageable. And most importantly, it's sustainable. It fits into real lives, real budgets, real people building real futures. And when you commit to investing that amount every single month, something powerful begins to happen. You build discipline, you remove hesitation, and you create momentum. This is where wealth truly begins, not with a large deposit but with a repeated decision. Let's put it into perspective. If you invest $100 every month and earn an average return of 8% per year, over time, your money doesn't just grow, it compounds. After 10 years, you've invested $12,000, but your portfolio could be worth over $18,000. After 20 years, that grows to nearly $60,000. And after 30 years, it can exceed $150,000, not because you invested more, but because you stayed consistent. This is the power of starting small. It removes the pressure to be perfect. It eliminates the need to wait. And it replaces hesitation with action. Because the biggest mistake most people make is not starting at all. They wait for the right time. They wait for more money. They wait for certainty. But in investing, time is your greatest advantage. The earlier you start, the more your money can grow. The longer you stay consistent, the stronger your results become. So instead of waiting, you begin. $100, 1 month, one step forward. That's all it takes to start building something meaningful. And in the chapters ahead, you'll learn exactly how to turn that small beginning into long-term financial growth. Because every investor starts the same way, with a single decision. And today, that decision is yours. Compounding is the real engine. If consistency is the habit that builds wealth, then compounding is the engine that drives it. Compounding is simple in concept, yet powerful in impact. It means that your money earns returns, and then those returns begin to earn returns of their own. In other words, you're not just growing your money, you're growing the growth. Let's break that down. When you invest your first $100, it begins to generate returns. Those returns are added to your original investment. The next time your money grows, it's not just growing from the original 100, it's growing from a larger base. And this cycle repeats, month after month, year after year. At first, the progress feels slow. In the early years, compounding is quiet, almost unnoticeable. But over time, something remarkable happens. Growth begins to accelerate. What once felt like small gains starts to build momentum, and eventually, that momentum becomes powerful. This is why starting early matters so much, because compounding needs time. The longer your money stays invested, the more opportunities it has to grow and grow again. Consider this. 2 investors both contribute $100 a month. One starts today, the other waits 10 years. Even if they invest the same amount monthly, the one who started earlier can end up with significantly more wealth. Not because they invested more money, but because they gave compounding more time to work. Time is what transforms small contributions into meaningful outcomes. And this is where many people underestimate the process. They focus on how much they're investing today instead of what that investment can become tomorrow. But compounding rewards patience, it rewards discipline, and most importantly, it rewards consistency. The key is to stay invested, to keep contributing, and to allow time to do what it does best. Because in the world of investing, compounding isn't just a benefit, it's the force that makes everything possible. Time is greater than timing. One of the most common questions new investors ask is simple: when is the right time to invest? It's a question driven by uncertainty, by the fear of getting it wrong, by the desire to wait for the perfect moment. But here's the truth. In investing, time matters far more than timing. Trying to predict the perfect moment to enter the market is not just difficult, it's nearly impossible. Markets rise, markets fall, and even experienced investors cannot consistently predict when those movements will happen. Waiting for the right time often leads to one outcome: not starting at all. And every month you wait is a missed opportunity for your money to grow. Because while you're waiting, time, the most valuable asset in investing, is slipping away. Let's shift the perspective. Instead of asking, when should I invest, ask, how long can I stay invested? That's where the real advantage lies. The longer your money remains invested, the more it benefits from compounding, the more it weathers short-term fluctuations, and the more it participates in long-term market growth. This is why consistent monthly investing is so powerful. It removes the pressure to time the market. It replaces uncertainty with discipline, and it allows you to invest through both highs and lows. Some months, you'll invest when prices are higher. Other months, when prices are lower. Over time, this balances out, and what you gain in return is something far more valuable than perfect timing. You gain consistency, you gain time, and you gain exposure to long-term growth. Consider this: missing just a few of the market's best days can significantly reduce your overall returns, and those best days often come when you least expect them, sometimes during periods of uncertainty or decline. If you're waiting on the sidelines, you risk missing the very moments that drive long-term growth. This is why disciplined investors focus on staying in the market, not trying to outguess it. Because success in investing isn't about being right at the perfect moment, it's about being present over time. So instead of waiting for clarity, instead of chasing perfect timing, you begin now, you stay consistent, and you let time do the heavy lifting, because in the end, it's not timing the market that builds wealth. Building your emergency fund, 3 to 6 months. Before you invest your first $100, you need a foundation. Because investing builds wealth, but stability protects it. And that stability begins with one essential tool: an emergency fund. An emergency fund is a dedicated pool of money set aside for unexpected events. Not for planned expenses, not for lifestyle upgrades, but for the moments you didn't see coming: a sudden job loss, an urgent car repair, a medical expense. These are the situations where, without a financial cushion, many people are forced to rely on debt. And debt, especially high-interest debt, can quickly undo the progress you're working so hard to build. This is why your emergency fund comes first. The goal is simple: to save enough to cover 3 to 6 months of essential living expenses. That includes your rent or mortgage, your utilities, your food, and your basic financial commitments. Not your luxuries, just your essentials. For some, 3 months may be enough. For others, especially those with variable income, 6 months provides greater security. The exact number matters less than the principle. You are creating a buffer between you and uncertainty, and that buffer gives you something incredibly valuable: peace of mind. Because when unexpected events happen, and they will, you won't need to panic. You won't need to sell your investments at the wrong time, and you won't need to rely on credit to get through. Instead, you'll have a plan. Now you might be wondering, should I delay investing until my emergency fund is complete? In most cases, yes. Building this foundation first ensures that your future investments can remain untouched and continue to grow. It protects your long-term strategy from short-term disruptions. Think of it this way: investing is about building your future. An emergency fund is about protecting your present. And both are essential. So before you focus on growing your wealth, take the time to secure your base. Start small if you need to. Stay consistent and build it step by step. Because once your foundation is in place, Every dollar you invest moving forward becomes stronger, safer, and more resilient. And that's how sustainable wealth is built. Clearing high-interest debt. Before your money can grow, it must stop working against you. High-interest debt is one of the biggest obstacles to building wealth. Because while your investments aim to generate returns, high-interest debt does the opposite. It compounds against you. Credit cards, payday loans, and certain personal loans often carry interest rates of 15%, 20%, or even higher. And that creates a difficult reality. If your investments are earning an average of 7 to 8%, but your debt is costing you 20%, you're moving backwards. This is why clearing high-interest debt is not just important, it's essential. Think of paying off this debt as a guaranteed return. Every dollar you use to reduce high-interest debt is effectively saving you from future interest charges. It's predictable, it's risk-free, and it strengthens your financial position immediately. Now, this doesn't mean you need to be perfect. It means you need a plan. Start by listing all your debts. Focus on those with the highest interest rates first. This approach, often called the avalanche method, helps you minimize the total interest you pay over time. Alternatively, some prefer the snowball method, paying off smaller balances first to build momentum and motivation. Both strategies work. What matters most is consistency, making regular payments, reducing balances steadily, and avoiding new high-interest debt along the way. You may still be able to invest small amounts while paying down debt, but your priority should remain clear. Eliminate the financial drag. Because once high-interest debt is removed, your money can finally begin to work for you, not against you. You gain control, you reduce financial stress, and you create space for real progress. This is what a strong financial foundation looks like: stable, intentional, and built to support long-term growth. Because investing isn't just about earning returns, it's about removing the barriers that hold those returns back. Putting a budget in place. If your emergency fund creates stability and clearing debt removes obstacles, then a budget provides direction. Because without a plan for your money, it's easy to lose control of where it goes. And when money lacks direction, building wealth becomes difficult. A budget isn't about restriction, it's about intention. It's a simple system that tells your money where to go, instead of wondering where it went. At its core, a budget helps you do three things: cover your essentials, manage your lifestyle, and invest in your future. Let's break that down. First, your essentials. These are your non-negotiables: housing, food, utilities, transportation. These must always come first. Second, your lifestyle. This includes the things you enjoy: entertainment, dining out, subscriptions. A good budget doesn't eliminate these, it simply keeps them within limits. And third, your future. This is where your $100 a month comes in. Your investments, your savings, your long-term goals. And here's the key: this category should not be what's left over. It should be planned from the beginning. This is often called paying yourself first. Before spending on anything else, you allocate money toward your future, even if it's just $100, because consistency matters more than size. Now, your budget doesn't need to be complicated. It can be as simple as a 50-30-20 structure. 50% for needs, 30% for wants, 20% for savings and investing. Or you can create your own system based on your situation. What matters is clarity, knowing how much you earn, knowing how much you spend, and making sure those numbers align with your goals. A budget gives you control. It removes guesswork, it reduces stress, and it ensures that your investing habit is sustainable. Because the goal isn't just to invest once, it's to invest every month. And that only happens when your finances are organized and intentional. So take the time to build your budget, adjust it as needed, keep it realistic, and most importantly, stick to it. Because when your money has a plan, your future has one too. 70% to index funds, the core of your portfolio. Now that you've built your foundation, it's time to put your money to work. The question is simple: where should your $100 go each month? The answer begins with one of the most powerful tools in investing: index funds. If your goal is long-term consistent growth, index funds should form the core of your portfolio. That's why in this strategy, 70% of your monthly investment, or $70, is allocated to them. So what exactly is an index fund? An index fund is an investment that tracks a group of companies, rather than relying on picking individual stocks. One of the most well-known examples is the S&P 500. This index represents 500 of the largest companies in the United States, including businesses across technology, healthcare, finance, and more. When you invest in a S&P 500 index fund, you're not betting on a single company. You're investing in the broader market. And that brings two major advantages: diversification and consistency. Diversification means your risk is spread across many companies, rather than concentrated in one. If one company struggles, others can continue to perform. This reduces volatility and creates a more stable investment experience over time. Consistency comes from the long-term performance of the market itself. Historically, broad market indexes like the S&P 500 have delivered average annual returns of around 7 to 10% over time. Not every year, but over the long term. And this aligns perfectly with your strategy. Because you're not trying to outperform the market, you're participating in it. And participation over time is enough to build meaningful wealth. Another key benefit of index funds is simplicity. You don't need to research individual stocks. You don't need to constantly buy and sell. Instead, you invest consistently and let the market do the work. This is especially powerful when combined with your monthly contributions. Every month, your $70 buys into the market, whether prices are high or low. Over time, this creates a balanced average cost and removes the pressure of making perfect decisions. This approach is disciplined, it's efficient, and it's proven. Because in investing, complexity doesn't guarantee better results. Often it's the simple, consistent strategies that perform the best. So as you build your portfolio, think of index funds as your foundation, the steady, reliable core that supports everything else. Because when 70% of your money is working in a diversified, long-term investment, you're not just investing, you're building a system designed for growth. 20% to international exposure, expanding beyond one market. While index funds form the foundation of your portfolio, true strength comes from diversification. And diversification doesn't stop at industries. It extends across the world. That's where your next allocation comes in. 20% of your monthly investment, or $20, is dedicated to international exposure. This means investing in companies outside of your home market. Businesses across Europe, Asia, emerging markets, and developing economies with long-term growth potential. Why does this matter? Because no single country leads the global economy forever. Markets move in cycles. At times, the US market may outperform. At other times, international markets take the lead. By investing globally, you reduce your reliance on any one economy, and that adds resilience to your portfolio. It ensures that your growth isn't tied to a single region, but supported by opportunities worldwide. International exposure also gives you access to different sectors and trends. For example, emerging markets may offer higher growth potential. Developed markets may provide stability and income. Together, they create balance. Now, just like with index funds, this approach is designed to be simple. You're not selecting individual international stocks. Instead, you invest in broad international index funds, or ETFs, covering hundreds, sometimes thousands of companies globally. This keeps your strategy efficient, diversified, and aligned with long-term growth. There may be periods when international investments underperform, and there will be times when they outperform. That's expected. The goal isn't to predict which market will win next. The goal is to be positioned for growth wherever it happens. This is what disciplined investing looks like. You don't chase trends. You don't react to short-term shifts. You build a portfolio that is prepared for the long term. So with 20% allocated internationally, you're not just investing in one economy, you're investing in the world. And that perspective is what strengthens your strategy over time. 10% to high growth or experimental assets. With 70% of your portfolio grounded in index funds and 20% expanding globally, the final 10% serves a different purpose: opportunity. This portion of your investment, just $10 a month, is allocated to high growth or experimental assets. These are investments with higher potential returns, but also higher risk. And that balance is important, because while your core portfolio is designed for stability and consistency, this portion allows you to explore growth beyond the average. This might include individual stocks in emerging industries, technology innovators, early-stage sectors with long-term potential, or even newer asset classes. The key word here is controlled. You are not risking your entire portfolio. You are allocating a small, intentional portion, just 10%. This ensures that even if these investments are volatile, your overall strategy remains strong and stable. Think of this as your learning and opportunity fund, a space where you can explore new ideas, understand market trends, and potentially benefit from higher growth, but with clear boundaries. Because without limits, high-risk investing can quickly become speculation, and speculation often leads to inconsistency. This is why discipline matters. You stay within your allocation, you avoid emotional decisions, and you focus on long-term potential, not short-term hype. Some of these investments may perform exceptionally well, others may not. That's part of the process. But because this is only 10% of your portfolio, you can participate in growth opportunities without putting your financial foundation at risk. Over time, this allocation can also evolve. As your knowledge grows, as your income increases, you may choose to adjust how you use this portion. But in the beginning, simplicity is key. Keep it small, keep it intentional, and keep it aligned with your overall strategy. Because successful investing isn't about taking big risks. It's about taking smart, controlled ones, and this 10% is where opportunity meets discipline. Beginner approach, 100% index fund. If you're just starting your investing journey, there's one approach that stands above the rest in its simplicity and effectiveness. Keep it simple. Instead of splitting your $100 across multiple investments, you can choose to invest 100% into a single index fund. One fund, one decision, one consistent habit. This approach removes complexity. You don't need to think about allocations, you don't need to analyze multiple assets, and you don't need to worry about getting the balance exactly right. You simply invest your full $100 each month into a broad market index fund, such as one that tracks the S&P 500 or global stock market index. And that's it. You're instantly diversified across hundreds, sometimes thousands of companies. You gain exposure to multiple industries, you benefit from long-term market growth, and you avoid the risks that come with picking individual stocks. This is why many experienced investors, even with years of knowledge, still rely heavily on index funds, because simplicity often leads to consistency, and consistency is what builds wealth. For beginners, this approach offers something incredibly valuable: confidence. You're not second-guessing your decisions. You're not reacting to every market movement. You're following a clear, proven path. And as you continue investing month after month, you begin to see progress. Not overnight, but steadily. Over time, you can always evolve your strategy. You may choose to diversify further. You may explore international markets, or allocate a small portion to higher growth opportunities. But in the beginning, none of that is required. Because starting simple is far more powerful than waiting for a perfect strategy. So if you're unsure where to begin here. $100, one index fund, every month, no complexity, no hesitation, just consistent progress toward your financial future. Intermediate approach, building a diversified portfolio. As your confidence grows and your understanding of investing deepens, you may be ready to move beyond a single index fund. This is where the intermediate approach comes in, a diversified portfolio. Instead of placing your entire $100 into one fund, you now spread it across multiple areas of the market, each with a specific role, each contributing to your overall strategy. A simple and effective structure looks like this: 70% in core index funds, your foundation for long-term growth; 20% in international exposure, expanding your reach across global markets; and 10% in high-growth or experimental assets, allowing room for opportunity. This approach builds on what you've already learned. It keeps the simplicity of index investing while adding layers of diversification and flexibility. Now, instead of relying on a single market, you're participating in multiple economies. Instead of limiting your exposure, you're expanding it. And instead of avoiding all risk, you're managing it intentionally. This is the key difference. You're not investing randomly. You're building a structured portfolio, one that balances stability and growth, one that is designed to perform across different market conditions. There will be times when one part of your portfolio outperforms the others. Your international investments may lead, or your higher growth assets may accelerate. At other times, your core index funds will provide stability. And that's exactly how diversification is meant to work. Not everything performs at once, but together they create balance. As an intermediate investor, your role also evolves. You begin to monitor your allocations. You may rebalance occasionally, bringing your portfolio back to its original structure. Not frequently, not emotionally, but intentionally. This keeps your strategy aligned with your goals, and most importantly, it keeps you disciplined. Because as your portfolio grows, the temptation to chase performance can increase. But true progress comes from staying consistent with your plan. This approach gives you both structure and flexibility. It allows you to grow with confidence while still keeping your strategy grounded. Because investing isn't about complexity. It's about clarity, consistency, and making decisions that support your long-term vision. And with a diversified portfolio in place, you're no longer just participating in the market. You're building a system designed to grow with you. Set up automatic monthly deposits. If consistency builds wealth, then automation protects it. Because no matter how strong your intentions are, life gets busy. Expenses come up, distractions happen, and without a system in place, even the best plans can fall apart. That's why one of the most powerful steps you can take is simple. Automate your investing. Setting up automatic monthly deposits ensures that your $100 is invested every single month without fail. No decisions, no delays, no second guessing, just consistency. Here's how it works. You choose a fixed date each month, often aligned with your income. And on that date, your investment account automatically receives your $100. From there, it's invested according to your strategy, whether that's a single index fund or a diversified portfolio. This process removes one of the biggest barriers to investing: emotion. Because when investing becomes manual, it becomes optional. You may hesitate when markets fall. You may delay when expenses rise, or you may try to wait for the right moment. But automation eliminates that uncertainty. It turns investing into a habit, not a decision. And that habit is what builds long-term success. There's another advantage to this approach. It naturally supports dollar-cost averaging. By investing the same amount each month, you buy more shares when prices are low and fewer when prices are high. Over time, this helps smooth out your average cost and reduces the impact of short-term market fluctuations. Now, setting up automation is straightforward. Most investment platforms allow you to link your bank account, schedule recurring deposits, and even automate your investment allocations. Once it's set up, your role becomes simple. Monitor occasionally, stay consistency, and avoid unnecessary changes. Because the goal isn't to constantly adjust your strategy, it's to stay committed to it. Automation creates discipline without effort. It keeps you invested during uncertainty, it keeps you consistent during busy periods, and it keeps your long-term goals on track. So once your system is in place, trust it, let it run, let it build, and let time do the work. Because when investing becomes automatic, success becomes repeatable. Dollar-cost averaging. Once your investments are automated, something powerful begins to happen behind the scenes. It's called dollar-cost averaging, and it's one of the simplest yet most effective strategies in investing. Dollar-cost averaging means investing a fixed amount of money at regular intervals, regardless of what the market is doing. In your case, that's $100 every month, no adjustments, no hesitation, no attempts to predict the market. Just consistency. Now, why does this matter? Because markets are constantly moving. Prices rise, prices fall, and trying to time those movements is incredibly difficult. But with dollar-cost averaging, you don't need to. When prices are high, your $100 buys fewer shares. When prices are low, that same $100 buys more. Over time, this creates a natural balance. You're not buying everything at the top, and you're not waiting on the sidelines for the perfect low. Instead, you're spreading your investments across time, and that reduces the impact of short-term volatility. Let's put it into perspective. Imagine investing a lump sum at the wrong moment, just before a market drop. The emotional pressure can be significant. But with dollar-cost averaging, that risk is reduced, because your investments are spread out. Market dips become opportunities, not setbacks. You're buying more when prices are lower, which can improve your long-term returns. This approach also supports one of the most important aspects of investing: discipline. You're not reacting to headlines, you're not chasing trends, you're following a system. And over time, systems outperform emotions. Now, it's important to understand, dollar cost averaging doesn't guarantee profits, and it doesn't eliminate risk, but what it does provide is consistency, structure, and a more balanced way to invest over time. It keeps you moving forward, regardless of market conditions. And that's exactly what long-term investing requires. So when you combine automation with dollar cost averaging, you create a powerful system, one that invests regularly, one that adapts naturally to market changes, and one that keeps you focused on the long term. Because in the end, successful investing isn't about reacting to every movement, it's about staying consistent through all of them. Ignore short-term market noise. As you begin investing consistently, you'll quickly notice something. The market is never quiet. Prices move daily. Headlines shift constantly. And opinions are everywhere. One day, markets are rising with optimism. The next, they're falling with uncertainty. This is what we call market noise. And for many investors, it becomes a distraction. Because short-term movements can feel significant. A sudden drop may create fear. A rapid rise may create excitement. And both emotions can lead to the same outcome: poor decisions, selling too early, buying too late, or abandoning a long-term plan altogether. This is why one of the most important investing skills is not reacting, because short-term market noise is not a reflection of long-term value. It's often driven by news, speculation, and temporary events. But your strategy, your $100 a month, is not built for the short term. It's built for years, for decades. And over that time, markets have historically trended upward, despite periods of volatility. This is where discipline matters most. When markets fall, your instinct may be to stop investing. But in reality, those moments often present opportunity. Lower prices mean your money buys more. And when combined with dollar cost averaging, this can strengthen your long-term results. When markets rise, there may be a temptation to invest more aggressively or chase performance. But again, discipline keeps you grounded. You stay consistent, you follow your plan, and you avoid emotional decisions. Because reacting to short-term noise often leads investors away from long-term success. Instead, you shift your focus away from daily movements and toward long-term progress. You measure success not by this week or this month, but by years of consistent investing. This is what separates successful investors from the rest. Not perfect timing, not constant adjustments, but the ability to stay focused when everything else feels uncertain. So as you continue your journey, remember this: the market will always have something to say, but you don't have to listen. Stay consistent, stay disciplined, and let your strategy work over time. Because in investing, ignoring the noise is often what makes the biggest difference. Avoid panic selling. At some point in your investing journey, the market will fall. It won't be gradual, it won't be comfortable, and it won't come with a warning. Prices will drop, headlines will turn negative, and uncertainty will rise. This is the moment where many investors face their greatest challenge, not strategy, but emotion. Because when your portfolio value declines, it's natural to feel concern. You may begin to question your decisions. You may feel the urge to protect what's left. And that's when panic selling happens. Selling investments during a downturn, driven by fear rather than strategy. It feels like taking control. But in reality, it often locks in losses. Because markets don't move in straight lines. They fall and they recover. And those recoveries can happen quickly, often when least expected. If you've already sold, you miss the rebound. And over time, that can significantly impact your long-term results. This is why avoiding panic selling is essential. Not because downturns aren't difficult, but because they are part of the process. Every long-term investor experiences them, and every successful investor learns to navigate them. The key is perspective. Instead of viewing market declines as losses, see them as temporary movements within a long-term trend. Because if your strategy is built on consistent, monthly investing, then downturns can actually work in your favor. Lower prices mean your money buys more. And when the market recovers, those investments have greater potential to grow. This is where discipline becomes your advantage. You don't react emotionally. You don't abandon your plan. You stay consistent. You continue investing. You trust the process. And you focus on the long term. It's important to remember, you haven't truly lost money unless you sell. Market values fluctuate, but long-term growth is driven by time and consistency. So when the market becomes uncertain, Take a step back, revisit your strategy, remind yourself why you started, and most importantly, stay invested. Because successful investing isn't about avoiding downturns, it's about staying committed through them. And those who do are the ones who benefit when the market recovers. Stay invested during downturns. Market downturns are not exceptions, they are part of the journey. At some point, the market will decline, sometimes gradually, sometimes sharply. And when it does, it can feel uncomfortable. Your portfolio value may drop, progress may seem to reverse, and doubt may begin to creep in. This is where many investors step away. They pause their investments, they move to cash, or they wait for things to stabilize. But here's the reality. By the time the market feels safe again, much of the recovery has already happened. Because markets don't wait for certainty. They recover quietly, often when confidence is still low. This is why staying invested during downturns is one of the most important principles in long-term investing. Because your success isn't determined by avoiding difficult periods. It's determined by how you respond to them. When you continue investing during a downturn, you're doing something powerful. You're buying at lower prices. The same $100 that once bought fewer shares now buys more. And over time, this can significantly improve your long-term returns. This is where your system works in your favor. Your automated investments continue. Your dollar cost averaging remains active, and your strategy stays consistent. No adjustments, no emotional decisions, just discipline. It's important to understand downturns are temporary. Every major decline in market history has eventually been followed by recovery. Not immediately, not predictably, but consistently over time. And those who remain invested are the ones who benefit from that recovery. This is why your focus must remain long-term, not on where the market is today, but on where it could be in 5, 10, or 20 years. Because your $100 a month is not meant to perform in a single moment. It's designed to grow over time. So when the market declines, don't step back. Lean into your strategy. Stay consistent, stay invested, and trust the process you've built. Because in investing, the greatest opportunities often appear when confidence is at its lowest, and those who stay the course are the ones who move forward when the market recovers. Focus on long-term vision. In investing, what you focus on shapes how you behave. If you focus on daily market movements, you'll feel every rise and every fall. If you focus on short-term results, you may begin to question your strategy too often. But when you focus on the long term, everything changes. Because long-term investing isn't about reacting to the present. It's about building for the future. Your $100 a month is not designed to transform your finances overnight. It's designed to grow steadily, over years, over decades, and that requires a different perspective. Instead of asking, "What is my portfolio doing today?" you begin to ask, "Where is this heading over time?" This shift in thinking is powerful. It reduces emotional decision-making, it strengthens your discipline, and it keeps you aligned with your goals. Because when your vision is long-term, short-term fluctuations lose their significance. A market dip becomes temporary. A period of slow growth becomes expected, and progress is measured over years, not days. This is how successful investors think. They don't chase quick results. They don't react to every headline. They stay focused on the bigger picture. And that bigger picture is built on 3 things: time, consistency, and patience. Over long periods, markets have historically grown, not in a straight line, but with an upward trend. And your strategy is designed to capture that growth, but only if you stay committed. This is why your long-term vision matters. It acts as your anchor. When markets are uncertain, it keeps you steady. When progress feels slow, it keeps you motivated. And when distractions appear, it keeps you focused. So take a moment to define your vision. What are you investing for? Financial independence, security, freedom of choice, whatever your goal, keep it clear, because that clarity will guide your decisions. And when your actions align with your long-term vision, consistency becomes easier, discipline becomes natural, and progress becomes inevitable. Because in the end, successful investing isn't about short-term wins. It's about staying focused on what truly matters over time. Increase contributions with income. Your first $100 a month is where the journey begins. But it's not where it ends. As your income grows, your investments should grow with it. Because while consistency builds the habit, increasing your contributions accelerates the outcome. This is how you move from starting small to building meaningful wealth. Think of your $100 as your foundation. It proves that you can invest regularly, it builds discipline, and it creates momentum. But over time, your financial situation may change. You may receive a salary increase, a bonus, or create additional income streams. And with each increase, you have a choice: spend more or invest more. This is where long-term wealth is shaped. By choosing to increase your contributions, even gradually, you significantly enhance your future results. For example, moving from $100 to $150 a month may not feel like a major shift today, but over time, that additional $50 can compound into thousands. And the earlier you increase your contributions, the greater the impact, because those additional investments have more time to grow. This is why many successful investors follow a simple rule: increase your investments with your income, not necessarily all at once, but consistently. You might choose to allocate a percentage of every pay rise, increase contributions once or twice a year, or reinvest bonuses instead of spending them. The exact method matters less than the principle. Your lifestyle doesn't need to rise at the same pace as your income, because when your investments grow alongside your earnings, your future strengthens without sacrificing your present. This approach also keeps your progress aligned with your goals. As your income expands, so does your capacity to build wealth. And instead of relying solely on time and consistency, you begin to add scale, more capital, more growth potential, more momentum. This is where investing becomes more than a habit. It becomes a strategy, a system that evolves with you. So as your income increases, don't overlook the opportunity. Adjust your contributions, strengthen your plan, and continue building on what you've already started. Because the path to financial growth isn't just about where you begin, it's about how you expand along the way. Reinvest dividends. As your investments begin to grow, they can start to generate something powerful. This income often comes in the form of dividends. Dividends are payments made by companies to shareholders, a share of their profits, distributed regularly. And while receiving dividends can feel rewarding, what you do with them matters even more. Because instead of spending this income, you have an opportunity to accelerate your growth by reinvesting your dividends. Reinvesting means taking those earnings and using them to purchase more investments, more shares, more exposure, more potential for future growth. And this is where compounding becomes even more powerful. Not only are your original investments growing, but now your earnings are generating growth as well. It's a cycle: invest, earn, reinvest, repeat. Over time, this creates momentum. Your portfolio begins to expand not just from your monthly contributions, but from its own internal growth. And this can significantly increase your long-term results. Many investment platforms offer what's known as a dividend reinvestment plan, often called a DRIP. This allows your dividends to be automatically reinvested without requiring any manual action. Just like automation with your monthly deposits, this removes friction and keeps your strategy consistent. Now, it's important to understand, in the early stages, your dividends may seem small, a few pounds or dollars here and there. But over time, as your portfolio grows, those amounts increase. And when consistently reinvested, they become a meaningful contributor to your overall returns. This is why long-term investors focus not just on earning dividends, but on reinvesting them, because spending them slows your growth. Reinvesting them accelerates it. It keeps your money working, it keeps your strategy aligned, and it strengthens the compounding process you've already begun. So as your portfolio evolves, make this a standard part of your approach. Don't interrupt the cycle. Let your investments build on themselves, because in the long run, it's not just what you invest, it's what you reinvest that makes the difference. Add new income streams. There are two ways to grow your investments. You can rely on time, or you can increase the amount you invest. And one of the most effective ways to do that is by creating new income streams. Because while your primary income provides stability, additional income creates opportunity. It gives you more flexibility, more capacity to invest, and more control over your financial future. This doesn't require a major business or a complete career change. It can start small: a side project, a freelance skill, a digital product, or a service you can offer in your spare time. The goal isn't immediate scale, it's creating an additional flow of income that can be directed toward your investments. And here's where the strategy becomes powerful. Instead of increasing your lifestyle with this new income, you invest it fully, consistently, intentionally. This creates a separation. Your primary income supports your life. Your additional income builds your future. Over time, this can significantly accelerate your progress, because now you're not just investing $100 a month. You might be investing 150, 200, or more, and each increase compounds over time. What started as a small habit begins to scale into something much more impactful. There's another advantage to this approach: diversification, not just in your investments, but in your income. Relying on a single source of income can create vulnerability, but multiple income streams provide resilience. If one slows down, others can continue, and that stability strengthens your ability to stay consistent with your investing. Now, it's important to approach this strategically. Choose income streams that align with your skills, your time, and your long-term goals. Start manageable, stay consistent, and focus on building something sustainable. Because the goal isn't to overwhelm yourself, it's to expand your capacity, to create more opportunities to invest, more ways to grow, and more control over your financial direction. So as you move beyond your first $100, look beyond your current income, explore new possibilities, build additional streams, and channel that growth into your investments. Because when your income grows and your investments grow with it, your progress doesn't just continue, it accelerates. Trying to time the market. One of the most common and costly mistakes in investing is trying to time the market. The idea seems logical. Buy when prices are low, sell when prices are high. Simple in theory, but in reality, extremely difficult to execute consistently. Because timing the market requires two perfect decisions: when to get in and when to get out. And even experienced investors struggle to get both right. Markets don't move in predictable patterns. They react to countless factors: economic data, global events, investor sentiment, and uncertainty. And often, the biggest movements happen when least expected. This creates a problem. If you're waiting for the perfect moment to invest, you may end up waiting too long. And while you wait, your money isn't growing. On the other hand, if you try to exit the market to avoid losses, you risk missing the recovery. And those recoveries can be powerful. In fact, some of the market's best days occur shortly after its worst. Missing just a few of those days can significantly reduce your long-term returns. This is why timing the market often leads to inconsistent results. You may get it right once, or even twice, but over time, it becomes a cycle of guessing, and investing should never rely on guesswork. Instead of trying to predict the market, successful investors focus on participating in it. They invest consistently, they stay disciplined, and they allow time, not timing, to drive results. This is where your strategy gives you an advantage. Your $100 a month removes the need to predict. You invest regularly through market highs and lows. You benefit from dollar-cost averaging, and you stay aligned with long-term growth. No pressure to be perfect, no need to chase opportunities, just a clear, consistent system. Because in the end, the market rewards patience, not prediction. So instead of trying to time your way to success, focus on staying invested, stay consistent, stay disciplined, and let time do what timing cannot. Because the biggest gains in investing don't come from perfect decisions. In a world of constant market updates, real-time prices, and instant trading apps, it's easy to feel like you should always be doing something: buying, selling, adjusting your portfolio. But this leads to one of the most common mistakes in investing: overtrading. Overtrading is the habit of making frequent investment decisions without a clear, long-term strategy. It often comes from a desire to maximize returns or react quickly to market movements. But in reality, it can do more harm than good, because every time you trade, you introduce friction, transaction costs, potential taxes, and most importantly, emotional decision-making. Instead of following a consistent plan, you begin reacting to short-term changes. A stock rises, you buy more. A stock falls, you sell. And over time, this creates inconsistency. You move away from discipline and closer to speculation. There's another hidden cost to overtrading: distraction. The more you focus on daily movements, the harder it becomes to maintain a long-term perspective. You start chasing performance, comparing short-term results, and second-guessing your strategy. But successful investing doesn't require constant action. In fact, it often requires the opposite: patience. Your strategy is already designed to work over time. You invest $100 each month. You follow a structured allocation, and you allow compounding to take effect. This system doesn't need constant adjustment. It needs consistency. That doesn't mean you never review your portfolio. It means you review it with intention, periodically, calmly, and based on your long-term goals, not short-term noise. Rebalancing, for example, is a controlled and purposeful adjustment. Overtrading is reactive and frequent, and that distinction matters. Because when you reduce unnecessary actions, you reduce mistakes. You stay aligned with your strategy. You avoid emotional decisions, and you allow your investments to grow without interruption. So instead of asking, "What should I do today?" ask, "What does my long-term plan require?" And most of the time, the answer will be simple. Stay consistent. Because in investing, more action doesn't mean better results. Often, it means the opposite. And those who learn to do less, but do it consistently, are the ones who achieve more over time. Ignoring fees. When it comes to investing, some of the biggest costs are the ones you don't see. They're not obvious, they're not immediate, but over time, they can have a significant impact on your results. These are fees. Investment fees may seem small at first glance. 1%, 0.5%, even fractions of a percent. But when those fees are applied year after year, they compound, just like your investments. And that means they don't just reduce your returns, they slow your growth. Let's put it into perspective. Imagine two investors following the same strategy, earning the same average return. The only difference, one pays higher fees. Over time, that investor can end up with significantly less wealth, not because they made poor decisions, but because costs quietly reduced their progress. This is why understanding fees is essential. Common types include fund management fees, platform or account fees, and transaction costs. Individually, they may seem minor, but together they add up. This is one of the reasons index funds are so powerful. They are typically low cost, they don't require active management, and they allow you to keep more of your returns, which aligns perfectly with your strategy, because every pound or dollar saved in fees is money that stays invested, money that continues to grow, and money that contributes to your long-term results. Now, this doesn't mean you should avoid all fees. Some costs are necessary, but the goal is to be aware and to minimize them where possible. Choose low-cost funds, use efficient platforms, and avoid unnecessary transactions, because just like overtrading, frequent activity can increase costs, and those costs can quietly reduce your progress. Successful investing isn't just about what you earn, it's also about what you keep. So as you build your portfolio, pay attention to the details, understand the fees, keep them low, and make sure your strategy remains efficient. Because over the long term, small percentages can make a big difference, and those who manage costs effectively are the ones who maximize their growth. Chasing trends. In today's world, investment trends move fast. A new stock gains attention, a sector suddenly takes off, or a new opportunity dominates headlines and social media. And with that attention comes excitement, the fear of missing out, the urge to act quickly, the feeling that you need to get in before it's too late. This is where many investors fall into a common trap: chasing trends. Chasing trends means investing based on popularity, rather than strategy. It's reacting to what's already rising, instead of focusing on long-term value. And by the time something becomes widely popular, it's often already experienced significant growth, which means the potential upside may be limited, while the risk increases. This creates a cycle. Prices rise, attention follows. Attention grows, more investors enter. And eventually, momentum slows, sometimes sharply. And those who entered late are often the most affected. This is why trend-based investing can lead to inconsistency. You're not following a plan, you're reacting to movement, and over time, this can pull you away from your long-term goals. Now, this doesn't mean you should ignore innovation or new opportunities. It means you approach them with discipline. This is where your strategy protects you. Your core portfolio, your index funds and global exposure, remain steady and consistent. And if you choose to explore trends, you do so within your defined allocation. That 10%, your high-growth or experimental portion, is where curiosity belongs, not your entire portfolio. This creates balance. You can participate in new opportunities without risking your foundation. Because successful investing isn't about chasing what's popular. It's about committing to what works over time: consistency, diversification, and discipline. Trends will always come and go, but a strong strategy remains. So instead of asking, what's trending right now? Ask, does this align with my long-term plan? And if it doesn't, let it pass. Because in investing, not every opportunity needs to be taken, and sometimes the smartest move is staying exactly where you are. Month 1. Open your investment account. Every strategy begins with a single step, and in your investing journey, that step is simple. Opening your investment account. This is where your plan becomes real. Because until your money has a place to go, it cannot begin to grow. Now, this step may feel unfamiliar at first. You might wonder which platform to choose, what type of account to open, or how to get started. But the process is more straightforward than it seems. The goal is not perfection, it's progress. Start by choosing a reputable investment platform. Look for one that is easy to use, low cost, and aligned with long-term investing. Many platforms today offer simple, beginner-friendly interfaces that allow you to invest in index funds and ETFs with ease. Once you've selected your platform, you'll need to create your account. This typically involves providing your personal details, verifying your identity, and linking your bank account. It's a one-time setup, and it lays the foundation for everything that follows. Next, choose the type of account that suits your situation. Depending on your location, this could be a standard investment account or a tax-efficient option. The key is to select an account that supports long-term growth. Now here's where momentum begins. Once your account is open and connected, you're ready for the next step, funding it. Even if you don't invest immediately, transferring your first amount, no matter how small, creates commitment. It moves you from planning to action. And that shift is powerful. Because many people spend months researching, waiting, and delaying their first step. But progress doesn't come from waiting. It comes from starting. So in month 1, your goal is not to master investing. It's simply to begin. Open your account, understand the platform, and prepare yourself for consistent action in the months ahead. Because once this step is complete, you've removed the biggest barrier, getting started. And from here, everything becomes easier. One step leads to the next. One action builds momentum, and one decision sets the foundation for your future. So take that step, open your account, and begin your journey. Month 2, your first $100 invested. In month 1, you prepared, you opened your account, you set the foundation, you took the first step. Now in month 2, you take the most important action of all. You make your first investment, $100. This moment matters, not because of the amount, but because of what it represents. It's the shift from intention to execution, from learning to doing. Now, as you prepare to invest your first $100, keep it simple. You don't need a complex strategy. You don't need perfect timing. You just need to begin. If you're following the beginner approach, this means investing your full $100 into a broad market index fund. One decision, one investment, and you're in the market. If you're ready for a more structured approach, you can begin applying your allocation. $70 into index funds, $20 into international exposure, and $10 into high-growth opportunities. Either way, the principle remains the same. You are investing consistently. Now, as you confirm your investment, you may feel a mix of emotions: excitement, uncertainty, even hesitation. That's completely normal, because this is new. But remember, you're not making a one-time decision. You're building a habit, and this first investment is the beginning of that habit. From this point forward, your focus shifts from starting to continuing. Because investing once is easy. Investing every month, that's where results are built. So don't overanalyze this step. Don't wait for the perfect moment. The goal is not perfection, it's participation. Once your first $100 is invested, take a moment to acknowledge it. Because you've done something many people never do. You've started. And that single action puts you ahead. Ahead of hesitation, ahead of delay, ahead of inaction. From here, the path is clear. Stay consistent, follow your plan, and return next month to do it again. Because wealth isn't built in one investment, it's built in the decision to keep going. And now, you've taken that first step. Month 3-12. Automate and review quarterly. By now, you've done what many never do. You've started. Your account is open. Your first $100 is invested. Now, the focus shifts from starting to sustaining. Because real progress in investing doesn't come from a single action, it comes from repetition. From month 3 to month 12, your role becomes simple: automate and review. First, automation. Set up your monthly investment to happen automatically. The same $100, the same date each month, the same strategy. No decisions required. This transforms investing from something you think about into something that simply happens. And that consistency is what builds momentum. Month after month, your investments continue. Through market highs, through market lows, without interruption. This is how discipline is maintained, not through willpower, but through systems. Now, while automation keeps you consistent, reviewing keeps you aligned. But here's the key: you don't need to check your portfolio every day, or even every week. Instead, you review quarterly, every 3 months, calmly, intentionally, without emotion. During these reviews, you focus on a few simple questions. Are you staying consistent with your monthly contributions? Is your portfolio aligned with your intended allocation? Have your goals or financial situation changed? That's it. No overanalysis, no reaction to short-term movements, just a structured check-in. If your allocations have shifted significantly, you may choose to rebalance, bringing your portfolio back to its original structure. Not frequently and not impulsively, but when necessary. This keeps your strategy on track. It ensures that your risk remains controlled and that your long-term plan stays intact. As the months pass, something important begins to happen. Your habit strengthens, investing becomes routine, your confidence grows, and your portfolio begins to build. You're no longer starting, you're continuing. And that's where the real results are created. Because wealth isn't built in dramatic moments, it's built in quiet, consistent actions repeated over time. So from month 3 onward, trust your system, automate your contributions, review with intention, and stay focused on the long term. Because when your strategy is consistent and your actions are disciplined, progress becomes inevitable. One decision, repeated. You've reached the end of this guide, but more importantly, you've reached the beginning of your journey. Because everything you've learned comes down to one simple idea. Wealth is built through consistency, not large one-time decisions, not perfect timing, and not complex strategies, but small, intentional actions repeated over time. $100 a month. And first, it may feel small, almost insignificant. But as you've seen, it's not the size of the investment that matters. It's the habit behind it. The discipline to continue, the patience to stay invested, and the clarity to focus on the long term. You've built your foundation. You understand the power of compounding. You've created a strategy, and you've put a system in place. Now, your role is simple. Stay consistent. There will be moments of uncertainty. There will be periods of slow progress, and there will be times when the market tests your patience. But through all of it, your advantage remains the same: time. Because while others wait, you're investing. While others react, you're consistent. And while others search for shortcuts, you're building something sustainable. Month by month, step by step, decision by decision. And over time, those decisions begin to compound. Not just in your portfolio, but in your confidence, your discipline, and your financial future. So as you move forward, remember this: you don't need more complexity. You don't need more information. You simply need to continue. $100 every month, because in the end, it's not about how you start. It's about how consistently you continue. And that's what turns small beginnings into lasting wealth.